So a bunch of folks have actually asked me what is Reg CF. So I thought I'd give you a little bit of background. So in essence, it's the government's attempt to make it easier for the public to invest in companies. The reason for this is that the initial public offering process has become very complicated, very expensive. And in the old days, where it was designed to be easy to raise capital through an IPO, and typically companies would look to raise 2, 3, 4, 5 million, and the bigger companies, Microsoft was one of the largest IPOs in those days, and they were really only looking at raising $26 million. So the world has changed though. So the cost of going public on the NASDAQ or the New York Stock Exchange is a big process, and it's a lot of planning, a lot of work, and it's typically going to cost somewhere between about $3 and $6 million. So it defeats the whole concept of what the initial public offering market was originally designed to do. So what the government actually did is in 1934, they had this rule that Securities and Exchange Commission rule, Section 12B of the SEC Act of 1934, that limited the number of shareholders in a private company, or in any company that wasn't public, to 500. Now that's not really a problem in those days, but as the world has evolved and you look at companies like Facebook and Google, before they went public, they all had a lot more than 500 shareholders. And Facebook was the one that sort of the straw that broke the camel's back. So the government was faced with a situation. They either prosecute Facebook for having too many shareholders, or the SEC shows that they don't have any teeth, or the government actually creates a new set of rules. And this was a great opportunity. So the US government, the SEC and FINRA all worked together, and they added it during the Obama administration, to what was called the Jobs Act. Very, very cleverly put. They said it will stimulate investments in everything from early stage companies, startups, established businesses, and they set some limits. So when they first launched this concept called Reg CF, it limited the investment, the maximum investment, limited the maximum number of shareholders to 5,000, which was an arbitrary number again. So they just went from 500 to 5,000. And then they limited the total amount that could be invested to 1 million, and they limited the number that the people could invest. They made it once again overly complicated, as government is wont to do. Well, after lots of iterations and a lot of workings, I think it was about 2 years ago, they eventually got it refined. There's many, many drafts later. And Reg CF through the SEC has now evolved that still has a limit. You can only raise a maximum of 5 million. So it doesn't compete against the New York Stock Exchange and that. But they've made it that much easier to invest. There's a bunch of companies you've got to deal with. In our case, we had to deal with 9 different businesses just to get this done. You've got your dealer broker, you've got obviously the SEC you have to submit your stuff to, you've got your regulation filing companies, you've got your accountants, and then you've got auditors, and you've got a whole bunch. It's a bit of a nightmare. It took us a lot longer than we thought it would be, but at the end of the day, it's a whole bunch of forms you have to fill in and filings you have to make and all this other stuff. But the key there is it's a mini version of a public offering. Now, there's some differences between a Reg CF and a traditional IPO. In a traditional IPO, the investors can bid up the share price. In a Reg CF, for whatever reason, the SEC stopped that happening. I think it was to stop competition. So the key is you can just make available a range of shares, and rather than raising more, what you can do is you can actually allow more shares. So you have what's called a minimum amount and a maximum amount to raise. Whereas in a traditional IPO, you allocate a fixed number of shares. And then the people bid up how much they want to invest. In other words, more keen people are to invest, the higher the share price. So that's one of the downsides of a Reg CF, is that the share price is fixed. There are some steps that you can add as well in a Reg CF, which is quite interesting. You can allow early investors, for example, friends and family, to get a discount. That makes it a little bit better. And there's still a few other rules, as the government loves to do. But the process is a hell of a lot easier than doing a traditional public offering. So it makes it a little bit more streamlined. And the big advantage that it does is it actually gives a value to the equity in the company. In other words, if people aren't going to invest, it means the company's not worth that. But if people are prepared to invest, it means that's what the market's seeing as the value. There is a secondary market as well, which allows you to trade the shares, but the regulation CF has a lockup period of 18 months, which means you can't trade the shares, which also stops any what they call pump and dumps and things like that. It makes sure that the company is actually submitting financial statements and you're communicating with investors, etc. So it's an interesting approach. 2021, the total raise, even though Reg CF is fairly new, the total raise broke just over $1 billion US. It was 1 billion and 07, and it looks like 2022 total Reg CF raises will be in the region of about 1.4 to 1.5 billion. And the secondary markets are the ones that are key. Now, that said, when you invest in a Reg CF, you still have the right to transfer the shares after the 18 months, whether it goes through a secondary exchange or it doesn't. In our case, we will obviously be going through a secondary exchange. Hope that helps, and feel free to ask me any other information. Cool. Cheers, bye.